In January 2019, WeWork was worth $47 billion. By October of that same year, its CEO had been fired, its IPO had collapsed, and the company was on the verge of bankruptcy. In less than 9 months, more than $40 billion in value had disappeared. This wasn't a market crash. It wasn't a pandemic. It wasn't bad luck. It was one of the greatest corporate illusions ever constructed, and the story of how an entire industry of sophisticated investors chose to believe it. To understand how WeWork collapsed, you first need to understand what it actually was. On the surface, WeWork was simple. Lease large office spaces from landlords, divide them into smaller desks and private offices, then rent those to startups, freelancers, and corporations at a markup. It was, at its core, a real estate subletting business. But WeWork's founder, Adam Neumann, never described it that way. He called WeWork a physical social network. He said the company's mission was to elevate the world's consciousness. He compared the ambition of building WeWork to the ambition of building cities. And somehow, almost impossibly, the most powerful investors in the world believed him. Adam Neumann was born in Israel in 1979. He grew up partly on a kibbutz, a communal farming community, and served in the Israeli Navy before moving to New York in 2001. His early business ideas were modest at best. He tried selling baby clothes with knee pads sewn into them. He started a company making women's shoes with collapsible heels. Neither worked. But in 2010, he co-founded WeWork with Miguel McKelvey in Lower Manhattan. The timing was ideal. The 2008 financial crisis had left office buildings half empty across the city. The startup economy was booming. Young entrepreneurs needed professional space they couldn't afford alone. WeWork's first location filled completely within days, and Neumann had found his stage. He was 6'5", magnetic, and relentlessly energetic. He surfed in the Hamptons and meditated in the office. He threw legendary company parties, with tequila shots at all-hands meetings as a regular feature. He didn't sell desk space. He sold belonging, community, a sense of purpose. And for a while, it worked spectacularly. By 2014, WeWork had raised $150 million in venture funding and carried a valuation of $1.5 billion. By 2016, $16 billion. By 2018, $20 billion. Every funding round seemed impossible. Every valuation seemed detached from reality. And every time, the checks kept coming. The largest check came from Japan. Masayoshi Son, the founder of SoftBank and one of the most powerful technology investors in the world, met with Adam Neumann in 2016. The meeting lasted 28 minutes. Son reportedly committed $4.4 billion on the back of a napkin. His stated reasoning: in a fight, it's better to be crazy. SoftBank would ultimately invest more than $10 billion into WeWork. With that money, WeWork expanded at a pace that defied physical logic. By early 2019, WeWork operated 425 locations across 100 cities in 27 countries. It was the largest private office tenant in Manhattan, London, and Washington, D.C. simultaneously. Its valuation peaked at $47 billion. For context, That made WeWork worth more than the combined market capitalization of every major US airline at the time. For a company that rented desks. But underneath the growth was a structural problem that had been hiding in plain sight. WeWork's business model had a fundamental flaw. To acquire locations, WeWork signed long-term leases with landlords, typically 15 to 20 years. These were fixed, legally binding obligations. Then WeWork rented those same spaces to its members on month-to-month or one-year contracts. This created a dangerous imbalance. WeWork had long-term, unmovable costs and short-term, easily cancelled revenue. In any economic downturn, members could leave overnight. Landlords couldn't. The company was structurally fragile by design, and it was losing money at a staggering rate. In 2018, WeWork generated $1.8 billion in revenue and lost $1.9 billion. It spent approximately $2 for every dollar it earned. The reaction from Wall Street was swift. WeWork filed its S-1, the legal document required to go public on the stock market. This was supposed to be the moment of legitimacy, the moment WeWork joined the world's most scrutinized companies. Instead, the S-1 became the document that ended everything. Journalists, analysts, and institutional investors, reading the filing in detail for the first time, found disclosures that had never been made public. Neumann had structured his shares so that each carried 20 votes, compared to 1 vote per share for ordinary investors. He had absolute, unchallenged control of the company, regardless of how much of it he actually owned. The company's official mission, to elevate the world's consciousness, was written into the legal document. Major pension funds and institutions were being asked to bet retirement savings on consciousness elevation. WeWork had been paying rent on buildings that Neumann personally owned, direct conflicts of interest that had never been disclosed. The losses were worse than anyone outside the company had known. The reaction from Wall Street was immediate and severe. The $47 billion valuation began collapsing in real time. Banks that had publicly supported the IPO began quietly distancing themselves. The financial press turned sharply negative. Employees who had joined WeWork on the promise that their stock options would make them wealthy watched the value of those options fall toward zero. By mid-September 2019, the IPO was officially postponed indefinitely. By late September, Adam Neumann resigned as CEO. His exit terms were extraordinary, even by the standards of corporate failure. SoftBank paid Neumann approximately $1.7 billion to leave the company he had driven into the ground. He had destroyed $40 billion in value. He walked away with $1.7 billion. WeWork continued to operate under new management, kept alive by emergency funding from SoftBank, but the structural problems had not changed. If anything, what came next made them worse. When COVID-19 hit in 2020, WeWork's entire value proposition collapsed in weeks. Why would any company pay for shared office space when the entire global workforce was suddenly at home? Revenue fell, memberships were cancelled, locations closed across the world. WeWork spent the next 3 years in managed decline, closing locations, renegotiating leases, reducing headcount, trying to present a credible path to profitability. In October 2023, WeWork filed for Chapter 11 bankruptcy protection in the United States and Canada. The company that had once been valued at $47 billion emerged from bankruptcy proceedings worth approximately $50 million, a destruction of 99.9% of its peak value. So what actually killed WeWork? Three things, and all three are patterns that repeat across industries, across decades, in companies of every size. First, a compelling story is not a business model. Neumann was extraordinary at narrative. He convinced investors, employees, and the media that WeWork was a technology company. But technology companies scale without limits. WeWork's costs scaled with every desk, every floor, every city. You cannot tell your way out of unit economics. Second, charisma without accountability is dangerous at scale. Neumann's behavior, the self-dealing, the conflicts of interest, the governance failures, was visible for years. But he had designed the company so that no board, no investor, no employee could remove him. By the time accountability arrived, the damage was done. Third, evaluation is not the same as value. $47 billion was not what WeWork was worth. It was what one investor's bet implied it could be worth, under assumptions that required everything to go right, permanently. When the public market demanded real numbers instead of projections, the fiction had nowhere to hide. WeWork didn't collapse in 2019. It was always collapsing. The IPO filing simply made it visible to everyone at the same time. Adam Neumann walked away and started again immediately. In 2022, he launched a new real estate startup called Flaw. Before the company had a single customer, Andreessen Horowitz invested $350 million into it. Some lessons, apparently, cost more to learn than others. If you found this useful, the next case is already waiting. Subscribe and you won't miss it.